Hey everybody, welcome to Mortgage Today for Monday, December 16th, 2024. And oh, what a day it was. UMBS were flat on the open. Stock futures were up 13.75 points in early trading. Bonds drifted sideways. Bonds drifted to slightly stronger levels in the overnight session, but began giving the gains back shortly after 8 a.m. Eastern Time. The just released S&P 500. The just released S&P Services PMI did more than expected. The just released S&P Services PMI did more than anything to contribute to that, as it bumped the 10-year yields up quickly into negative territory. The New York Fed manufacturing came in first at 0.2 versus 0.12 previously. New York Fed manufacturing index came in at 0.20 versus 0.21 forecast. New York Fed manufacturing came in at 20 versus a 12 reading that was forecast. It was 31.2 previously. S&P Services PMI, like we said, came in at 58.5 versus 55.7 forecast. It was 56.1 previously. That doesn't bode well for inflation, since so much of the economy is made up of services nowadays. The week ahead will be dominated by FOMC meeting on Tuesday and Wednesday. We will also get housing data with housing starts and existing home sales. Finally, we'll get the PCE inflation data on Friday, although it won't matter much coming after the Fed decision. With Christmas and New Year's landing in midweek, markets should be slow after that. Nick Timiraos of the Wall Street Journal, aka Nicky Leaks, is out with an article this morning saying that the Fed is ready to pause or dramatically slow further interest rate cuts. A few voting members have given indications they would argue against cuts this week. The growth in asset prices, particularly the stock market and Bitcoin, is another factor in the Fed's decision. In theory, these markets shouldn't matter to the Fed. Their mandate is goods, services, inflation, and unemployment, but shelter is a big component of inflation. As I mentioned on Friday's post, the Fed funds futures is already signaling the Fed will slow rate cuts next year. So in many ways, this is redundant. The Fed funds futures are much more cautious than the September dot plot, which saw the 2025 Fed funds rate in the 3 to 3.5 range. The current futures forecast sees the 2025 Fed funds rate at 3.75 to 4 range. So the markets are already forecasting what Nick suggests. The article also mentions the potential tariffs could sway the FOMC to slow rate cuts. If there was a prime directive of the bond market this week, it is to sell off regardless of any counter-argument in the from the economic data. The new week got off to a distinctly different start, with stronger economic data only causing a temporary inconvenience for bonds. Both MBS and Treasuries were pushed back in line with Friday's weakest level, but both found support in the PM hours before going on to make it back to unchanged territory or close to it. Volume was low and the volatility was smaller than the big picture, but at the very least, it was nice to see a different reaction to last week's default weakness. UMBS closed the day pretty much flat, down 1 basis point at 99.27. The 10-year closed out at 4.401. But we've definitely seen a strong drop-off in yields on the MBSs over the course of the last week or so. Pretty dramatic fall. We were testing that 100-day moving average, but now we're back down below that 25-day moving average. So hopefully we get some more bad news and can get some better rates.